Here's something most investors completely ignore. While everyone's glued to Nvidia's next earnings call or debating whether the S&P 500 is overextended, a completely different game is playing out in the micro-cap space. And the people who know these companies best are buying. I'm talking about insiders, CEOs, executive vice presidents, directors sitting on these boards. They're not getting paid to buy more shares. They already have them. So when they reach into their own pockets and start loading up, that tells you something. Today I'm bringing you 3 tiny companies, all under $5 a share, all in the tech and AI space, where insiders are actively buying right now. We're going to go deep on each one, what they do, where they're going, what the risks actually are, and what you should do with this information. Before we get into it, if you're serious about finding these kinds of opportunities before the crowd catches on, hit subscribe. We drop breakdowns like this every week. Joining me today is market analyst Thomas Hughes, who ran these names through a serious insider buying screener to find them. Thomas, good to have you. Good to be here. Let's start with the macro picture, because these names don't exist in a vacuum. Something is happening in the market right now that is creating the conditions for this trade. Walk me through it. Yeah, so what we're really seeing is a fundamental shift in where investor appetite is going. We hit peak interest rates roughly a year ago. The Fed has been cutting. On top of that, you've got deregulation tailwinds and a more favorable business tax environment shaping up. That combination is pushing investors to take on more risk than they were comfortable with even 6 months ago. And the big-name tech stocks got genuinely expensive. Nvidia, Microsoft, Oracle, all incredible companies. But their valuations got stretched. And over the last couple of quarters, institutional money has quietly been rotating out of those high flyers and into smaller, cheaper names. And the Russell 2000 is showing that, right? Exactly. The Russell's been trading at record highs, setting new peaks almost week over week. On up days it leads, on down days it holds. That kind of relative strength is a signal you can't ignore. The rotation is real, but let's be honest here, because microcaps carry serious volatility. We've seen these names get absolutely crushed during periods of market stress. That's still a live risk. It absolutely is. A lot of these companies have little or no revenue. Some are pre-profit. Their valuations are entirely forward-looking, priced on what could happen, not what has happened. That makes them extremely sensitive to any shift in market sentiment. These are not stocks you put your mortgage payment into. These are speculative positions you size accordingly. Understood. Now, insider buying as a signal. Why does it matter specifically for these kinds of names? Because insiders don't have to buy. They're already compensated in shares. So when they start purchasing in the open market, especially in significant amounts, especially when the stock has been struggling, that's them putting their own money behind a belief that something is about to change. It's not a guarantee, but it's one of the most genuine signals you can find. All right, let's get into the names. Thomas, stock number 1. Now, when you look at this company from the outside, it might not set your world on fire. Cloud-based business video platform. Okay, sounds like something from 2015, but that's actually where the opportunity lives. Walk us through it. So Kalura has been around a while doing cloud-based video for businesses. Internal training, customer experience, that kind of thing. Legacy business, decent but not exciting. But they're making a significant pivot right now into AI. They're repositioning as a full customer and employee experience platform, where instead of someone landing on a static page, an AI is reading the context, who you are, what you're looking for, and actively guiding you through an experience. It's a meaningful product shift, and the insiders see that potential, which is why they're buying. Insiders own over 10% of the company, which is already significant. But the specific buyers here are the CEO and an executive VP, both making open market purchases. When you see top leadership reaching into their personal accounts, that's the signal worth paying attention to. Now let's talk about the chart, because it's not pretty. This stock is down roughly 25% year to date. What's driving that? And is there any case that we've found a floor? The downtrend reflects the legacy business floundering during the transition period, which is pretty normal for companies making these kinds of pivots. The old revenue is shrinking before the new revenue is kicked in. But technically, it does look like we're near a support level. There could be a little more downside before a real rebound. But the setup is there for a strong bounce if positive news comes through. What are institutions doing? They own about 30% of the company. For a market cap sitting around $180 million, that's actually a meaningful number. These aren't retail traders. These are firms that do serious due diligence, and they've been accumulating recently, which aligns with the insider buying signal. Analyst coverage? Thin. Just 2 analysts. Rating is a hold, but that's actually 1 buy and 1 sell, so there's a wide range of conviction. The most recent buy rating has a price target of around $3, which represents over 100% upside from current levels. But with just 1 analyst behind it, you have to treat that as a directional signal, not a consensus. There's one offset worth mentioning, though. A board member has been selling, and selling heavily. True. But context matters. That's one of the largest shareholders trimming a position. That's portfolio management, not a vote of no confidence. The CEO and EVP buying on the same stock, that carries more weight. Last question on this one, earnings. They had a small beat in the most recent quarter and they're nudging toward profitability. Given the transition they're in, upcoming news could be a real catalyst. That said, given how speculative this name is, the smart play is to wait for that news rather than front-run it. Good news, and you've missed a little upside. Bad news, and you've avoided a real hit. Right, don't chase the setup before the confirmation. Good rule. Of the 3 names today, I'll say up front, this is the weakest of the bunch, but it's worth watching. The other 2 are more compelling, and the last one especially, I want to save that for the end, because the institutional ownership data on it is genuinely striking. But first, stock number 2. Real quick, drop a comment below right now. Do you track insider buying when you research stocks? Yes or no? I'm genuinely curious how many of you are already using this signal. And if this breakdown is helping you think differently about where to look in this market, hit that like button. Stock number 2. This one is a digital marketing platform. And before you click away thinking this is another ad tech company going nowhere, hear Thomas out. Because the story here is about a pivot that's actually starting to work. So this company serves ads across a wide range of metrics and channels. Classic digital marketing business. But they've made a really deliberate decision to leave the legacy model behind and go all in on AI. They recently launched an AI-powered version of their platform, and the early signs of traction are genuinely interesting. What stood out to me in their last earnings call was how explicitly management acknowledged the shift. They didn't hide from it. They said point blank, "We've been relying on legacy revenue and we're leaving that behind." They've launched an active go-to-market push for the new platform. That kind of candor from a management team is actually a green flag. The chart doesn't look green, though. Down roughly 70% over the past year. That's a brutal number. And yet, analysts are still bullish. 7 analysts are tracking it right now. That's a meaningful coverage base for a company this size, and it gives us real conviction in the consensus. They rated a hold overall, but there are more buys in the mix than sells, and the consensus price target sits around $9.50. That's forecasting roughly 180% upside from where the stock is today. So why the gap between analyst optimism and the actual stock price? Analysts have been cutting price targets as results came in below old expectations. The business transition takes time. Revenue compresses during the pivot before the new platform drives growth. But the thesis is, once the AI platform revenue starts showing up in the numbers, you'll see analyst upgrades follow. And upgrades from a 7-analyst coverage base can move a stock meaningfully. Let's talk about execution risk. Big pivots like this, going from traditional marketing to an AI-native platform. What's the realistic failure mode? Pure execution failure. Technology transitions are hard. New platforms have to work, customers have to adopt them. The sales motion has to be rebuilt. Any one of those can stall. The other risk is that they're small enough that a larger competitor could simply outcompete them or acquire them before they realize the full upside. What does the institutional picture look like? This is where it gets impressive. Institutions own 96% of the stock. That is an extraordinary number for a company this size, and they've been buying aggressively. That level of institutional conviction, while the stock is down 70%, tells you that the smart money sees something the price doesn't yet reflect. 96% institutional ownership on a stock down 70% is the kind of data point that makes you stop and look twice. I'm adding this one to my paper trading watch list on MarketBeat. Not because I think you should chase it tomorrow, but because if the AI platform gains traction and we start seeing numbers improve, the upside from here could be significant. All right, let's get to the name I've been building up to. Share this video with one person in your life who's been talking about finding smaller, earlier stage opportunities in this market. This kind of analysis is exactly what those conversations need. And subscribe if you haven't. We do this every week. Stock number 3, and this one is different from the first 2. Different industry, different risk profile, and honestly some of the most impressive institutional data I've seen on a company this small. Thomas, take it. CS Disco is a legal-focused AI platform. Cloud-based. They're automating legal discovery. Think the mountains of documentation and evidence review that lawyers have to go through in litigation. AI-assisted, highly scalable. And the legal industry is one of the most data-intensive, paper-heavy sectors that exists, and currently has almost zero automation in this part of the workflow. That's a massive opportunity if they can execute. Exactly. They have real revenue, they're growing, and they're on track for profitability. Current forecast is 2028, but given the acceleration we've been seeing, that estimate might prove conservative. Now, insiders, who specifically is buying? The CEO, multiple directors, and several other C-suite executives. Collectively, insiders own about 16% of the company. That's a meaningful stake with real skin in the game, and they're actively adding to it. The chart has been painful, down almost 50% year to date. But what are you seeing technically that gives you confidence this isn't just more downside? The stock hit a bottom last year, rebounded strongly, and has since pulled back to retest that prior support level. That kind of pattern, test, fail, retest, hold, is how technical bottoms get confirmed. The insider buying is happening right at that level, and trading volume has spiked in a way that usually signals accumulation, not distribution. And institutions? 58% institutional ownership, and they're aggressively buying. For a company this size, we're talking a genuinely tiny market cap, that level of institutional involvement is remarkable. These are analysts who spent weeks modeling this business. They're not buying on a hunch, so you've got insider buying from the CEO and directors, 58% institutional ownership with active accumulation, technical support confirming, revenue growth, a path to profitability, and the automation of an industry that's almost entirely manual right now. That's the thesis in one sentence. Huge capacity for automation in an industry with almost no automation, and the company can already demonstrate a path to profitability, which for a company this size is genuinely differentiating. What's the primary risk? Execution timeline. Legal tech is a slow-moving industry. Firms take time to adopt new tools. Sales cycles are long. If adoption is slower than modeled, the profitability runway extends and the stock languishes. The other risk is the same as any small player. A bigger, better-funded competitor could enter the space. But the institutional data makes you believe the market has already thought through those risks and is still buying. That's exactly how I read it. I don't need to know everything about this company if the chart is telling me sophisticated money is accumulating at a confirmed support level. That's a signal worth paying attention to. All right, let's bring it home. 3 microcap names, all under $5, all in the AI and tech space, all with meaningful insider buying. Here's the honest ranking. If I had to order them by conviction, CS Disco is number 1. The combination of insider buying, 58% institutional ownership, technical confirmation, real revenue, and a clear automation opportunity in a massive industry makes it the strongest setup of the 3. Thrive is number 2. The 96% institutional ownership at a 70% drawdown is the kind of data that gets attention. The AI pivot needs to show up in earnings. But if it does, the analyst upgrade cycle could be explosive. Kalura is number 3. The setup is real. The insider buying is meaningful, but analyst coverage is thin, and the execution risk on the AI pivot is highest here. Watch this one. Don't front run it. Now, the most important thing I can leave you with. None of these are set it and forget it positions. These are speculative. Size them like it. Have a clear thesis for why you own each one, and a clear trigger for when that thesis is wrong. Thomas, thanks for walking us through these today. My pleasure. If you want to see the 12 stocks that corporate insiders are actually selling right now, the flip side of this story, Thomas put together a free special report on that. Link is in the description. Worth reading before you make any moves. If you found value in this breakdown, hit like, subscribe, and share this with someone who needs to hear it. We'll see you in the next one.